You know that feeling when you check your portfolio and see some solid growth? It's great, right? But there's a silent partner in your investments that's always taking a cut. Taxes. Well, it doesn't have to be that way. Today, we're going to dive into 6 powerful and totally legal strategies to help you keep more of your hard-earned money. This right here, this is the whole game. Every single dollar you save from taxes is another dollar that stays in your account, working for you, earning returns on itself. That's the incredible magic of compounding, and our entire mission today is to protect it. And here's the problem in a nutshell. You see a 10% return and you think, awesome. But after the government takes its slice, what you actually get to keep can be a whole lot less. That gap, that's where the compounding thief lives, quietly eating away at your future wealth. So let's stop it.
So, how do we fight back? Here's our game plan. We're going to build your very own tax-smart toolkit, one tool at a time. We'll kick things off with tax-free bonds and qualified dividends, then we'll get into the clever strategy of harvesting losses, check out some pro-level accounts, and wrap up with a super important concept of asset location. Let's get to it.
All right, first tool out of the box is tax-free bond income. We're going to focus on 2 specific kinds of bonds, municipal bonds and treasury bonds, because they come with some really fantastic tax breaks. For anyone in a higher income bracket, municipal bonds, or munis, can be an absolute game changer. So what are they? Well, they're basically loans to state and local governments, and here's the beautiful part. The interest they pay you is completely free from federal income tax. And if you buy a muni that was issued in the state you live in, the interest is often free from state and local taxes too. I mean, that's a triple tax-free win.
And this chart shows you exactly why that matters. At first glance, the muni bond might have a lower interest rate, a lower yield than a treasury bond. But once you factor in what you save on taxes, the whole story changes. You can see that for someone in a lower tax bracket, the treasury might still be a better deal. But as your income goes up, that tax-free feature of the muni makes its real after-tax return way, way higher. The key takeaway, always compare your investments on an after-tax basis.
And hey, let's not forget about U.S. Treasuries. Now, you do have to pay federal tax on the interest, but it's completely exempt from all state and local taxes. This is a huge deal if you live somewhere with high state taxes, like California or New York. It's just another smart way to legally shield some of your investment income.
Okay, tool number 2 is what I like to call the qualified dividend edge. This one is a really big deal because, believe it or not, the IRS does not treat all dividends the same. The kind of dividend you get can make a massive difference in your final tax bill.
So what's the magic ingredient that makes a dividend qualified? It's all about getting taxed at the much lower long-term capital gains rates. But there's a catch, and you have to pay attention to this part. You need to meet a specific holding period. You have to own the stock for more than 60 days inside a specific 121-day window. It sounds a little technical, but it is a crucial rule to remember. And this table right here shows you just how much that rule is worth. Look at this. Ordinary dividends are taxed just like your regular income, which can be as high as 37%, but qualified dividends, they get those special rates. For most people, we're talking about a tax rate of 15% instead of, say, 24% or more. That's a huge chunk of change you get to keep.
And for some people, it gets even better. For a married couple filing their taxes jointly who earns under about $100,000, the tax rate on their qualified dividends is 0. Yeah, you heard that right, a big fat 0%. So this is not just some strategy for the super rich, it's something that can help millions of everyday investors.
Okay, on to our third tool. Now this one might sound a little weird at first, but it is incredibly powerful. It's called tax loss harvesting. And it's basically the art of turning your investments that have gone down in value into a real tax advantage.
Let me walk you through how it works. It's actually pretty simple. Let's say you have one investment that's up $500 and another one that's down $500. Step 1, you sell the loser. This realizes that $500 loss for tax purposes. Then you can use that loss to completely cancel out the $500 gain from another sale. And the result, your net taxable gain is 0. You've literally used a paper loss to make a real tax bill vanish.
But, and this is a really big but, before you run off and start selling, there's one critical rule you have to know about. It's a trap that can completely blow up this entire strategy if you're not careful.
It's called the wash sale rule. And here's the deal. The IRS says you can't claim that tax loss if you sell an investment and then buy back the exact same one, or something substantially identical, within 30 days. So for example, you could sell an S&P 500 ETF from one company and immediately buy a different S&P 500 ETF from another company. That's fine. But you can't sell and then just rebuy the very same one a week later.
All right, let's move on to a more advanced tool in our kit. This is something that's really useful for investors who have, slightly more complex financial situations. We're talking about separately managed accounts, or SMAs.
So what's the big difference here? It's actually pretty simple. When you buy a mutual fund, what you own are shares of the fund. But with an SMA, you own the actual individual stocks and bonds directly. It's like having your own personal portfolio, but with a professional manager running it for you.
And that direct ownership is the key.
It means the manager can make decisions that are tailored specifically to your personal tax situation. They can be super strategic about when to sell a winner, or they can do tax loss harvesting just for your account. Now, full disclosure, SMAs usually have higher minimums, often starting at $100,000 or more. But for those who can access them, that personalized tax management can be incredibly valuable.
Okay, our final strategy is one that gets overlooked all the time, but it can be one of the most powerful of all. It's called asset location. And the whole idea isn't about what investments you own, but where you own them. I want you to think of your different accounts as 3 buckets. By putting the right assets in the right bucket, you can save a ton on taxes. So your regular taxable brokerage account, that's the best place for tax-efficient things like stocks. Your tax-deferred accounts, like a 401k or a traditional IRA, those are perfect for your tax-inefficient stuff, like most bonds. And finally, your tax-free Roth IRA, that's the absolute best home for your highest growth investments because they can grow for decades and you'll never pay a penny of tax on them.
Let's make this real with an example. A real estate investment trust, or a REIT, can be a fantastic investment, but its dividends are usually taxed as ordinary income, which is the highest rate. If you hold that REIT in your regular taxable account, you could be giving up 37% of your dividends to taxes every single year. But if you stick that same REIT inside your IRA, that tax drag completely disappears. It's the same investment, just in a smarter location.
And there you have it, your complete tax-smart toolkit. You can use tax-free bonds to shield income, get lower rates on qualified dividends, turn your losers into a tax advantage by harvesting losses, get personalized management with an SMA, and seriously boost your returns just by optimizing your asset location.
But I want to leave you with one final really important piece of advice. While all these strategies are powerful, they are just tools. They are not the entire plan. Your personal goals, how long you're investing for, and your own comfort with risk, those things should always be driving your decisions. Use these tax strategies to make an already good plan even better.
So you are now officially equipped with the knowledge you need to fight back against that compounding thief and keep more of your hard-earned money working for you.